private equity funds. So you run a platform for people to share their ideas. You know, we're looking at what happened with the latest 13Fs, and we see a few things, but one is generally poor performance among a lot of hedge funds these days, a lot of complaints about fees, and just generally it seems like a lot of crowded trades. Everyone was in that Valiant trade that blew up. What does it say about the state of the industry that so many people got taken for a ride on this one and are sort of all clustering into the same set of stocks?
So I don't actually think it says much. I think people read into 13Fs really a lot more than they should. I think one thing to keep in mind is that more than half of the hedge funds out there in the U.S. actually manage less than $100 million. So a lot of the focus is on the very large multi-billion-dollar funds, but there actually are thousands of hedge funds out there that don't necessarily pop up on the radar for positions like Valiant. I think one of the reasons why folks in the hedge fund industry, as well as in the long-only community, value SumZero is because they're getting a much more timely sort of view on what a specific analyst thinks about a given name, not just in terms of a price target, but in terms of a detailed defense of that price target and sort of a logical reasoning as to what is the rationale behind a particular name.
That may be the case, that there's a lot of smaller hedge funds out there, but the big ones certainly gather all the attention or attract all the attention, and they have the potential of moving the markets and moving stocks. We talk about crowded trades here. To what extent are hedge funds and the guys who populate hedge funds vulnerable to groupthink the same way that mutual fund managers are?
Well, everyone is vulnerable to groupthink, but I think you gotta sort of believe that as long as analysts are doing their homework, that they should be coming to their own independent conclusions. I guess it's something to watch out for, to the extent that you see the same names in every fund's portfolio. But I think the other thing to keep in mind is that 13Fs don't tell you, what's short in the portfolio, or if that manager has a pair trade on, what's the context of that specific name in terms of why, how it's in the portfolio. So there are all kinds of limitations to 13Fs that I think are worth considering.
Earlier on Bloomberg Go, we asked BMO Capital Markets, Brian Belsky, about hedge funds and what they're getting wrong. Let's take a listen to that.
Sure.
The hedge funds are all reactive. There's no independent thought. Oh, what did you do? You bought cat? Well, I'm going to buy cat. I mean, there's no thought leadership because they're so fixated on daily and weekly returns. And because of that, the standard deviation environment of returns is so out of whack. Nobody knows how to pick stocks anymore, and everyone's so focused on macro data points, we've forgotten how to get into the weeds, pick good stocks, good management, good companies, good themes.
So you already, the first half of what you said you already sort of addressed, but this issue of short-term thinking within hedge funds, and fund managers have complained about it, that their limited partners are inclined to pull out after a couple quarters of underperformance. How big of an issue is that for these fund managers, that they can't take out of consensus positions? Because if they go for any period of time of not matching the target, the money starts to flow out the door.
It's a huge issue, obviously. There is this sort of mismatch oftentimes between, the duration of a particular investment versus the redemption sort of terms of an LP investing in that fund. If you've got a fund that, where your investor can pull their money out, say on a monthly basis, and you're looking for longer term investments, you can obviously get caught in a bad situation. So I think you sort of see that a lot in terms of, some of the returns. I think also as an industry, performance-wise, you would expect a hedge fund, just by its nature, in a way, to underperform over a bull market, outperform a down market. And so, in the long run, I think the industry has sort of shown that it's been able to do that. Maybe recently there's been a lot of controversy just given the fact that there has been some degree of underperformance. But I think that mismatch between what your sort of investment horizon is versus what your investors what their kind of alignment is a big issue that, some funds really kind of get that right, some of them get that wrong.
Divya, tell us about SumZero's analyst ranking system, because what you guys do is not just buy, hold, sell on the most common companies, but you actually look for companies in special situations, M&A, one-time distributions.
Yeah, so just to be clear, it's not we, SumZero, but it's our community members who happen to work at funds that are making investment recommendations. And, I think the reason why these guys do come to SumZero is because there's analysis and insight on names that aren't exactly, necessarily making it to Bloomberg News or covered by Wall Street. And the rankings is really meant to show which analysts are consistently performing well, not just having one good idea on the platform, but having, a string of ideas that are consistent and performing well.
All All right, Divya Narendra, the CEO and co-founder of SumZero, thank you very much for joining us.
Coming up, Target is next in line for retail earnings. We dissect